At 1.8 times, this metric is fragile.
JPMorgan just told investors the Straits Times Index could hit 7,000 within 12 months. That is 22% above Tuesday's close, backed by 4 named conviction stocks. Before you reallocate a single dollar on that headline, we need to examine what those 4 names actually look like up close. I'm Iggy. I run the numbers on SGX stocks, so retirees don't have to guess whether a headline call is safe to follow. Turning to the overview of who this target impacts. A 22% upside call from a global investment bank is the kind of headline that changes investor behavior overnight. JPMorgan is putting its name behind 4 specific SGX stocks to drive this entire rally. But before taking that headline at face value, we have to look beneath the index target and inspect the individual vehicles carrying the load. Whether you are planning to park fresh CPF or SRS capital into SGX equities today, or you are an existing holder sitting on DBS or Keppel shares from years back, this call directly affects your capital allocation decisions. The core question is simple. Do these 4 conviction stocks actually clear our forensic hurdle? Or are the macro bull case and the stock balance sheets telling 2 completely different stories? Looking at the bank's thesis, JPMorgan points to a Goldilocks economic backdrop, resilient earnings growth, a stable Singapore dollar, and fresh institutional flows from the Equity Market Development Program. Their track record this year is notable. They raised their base case to 6,000 back in January, and the index has climbed 16% since. Their top 4 conviction picks for this next leg up are DBS Group, Singapore Exchange, Keppel, and UOL Group. This upgrade is supported by real macroeconomic strength. Singapore's second quarter GDP was revised up to 5.9% year-on-year, with full year 2026 growth now forecasted between 4.5 and 5.5%. Manufacturing expanded 12.5% on AI semiconductor demand. The macro backdrop is not manufactured optimism, but the critical question sits one level below at the individual stock level. Close but not there yet. Turning to the first name, DBS trades on a trailing ordinary yield of 3.44% and a total yield of 4.23% including capital returns. Both figures fall short of our 4.7% minimum yield hurdle. The total yield misses the bar by 47 basis points, placing DBS in Zone 4 Plus as a growth read. The balance sheet underneath DBS is remarkably solid, with transitional CET1 capital at 16.6%, well above the 16% Zone 1 floor, and 0 weighted soft flags. This is not a structural quality failure. It is a narrow test against our 4.7% hurdle, which is benchmarked against CPF special account to maintain strict capital discipline. Zone 4 Plus is a timing verdict, not a permanent rejection. And 2 different readers might reasonably weigh this differently. Someone with a genuinely long runway before drawing on retirement savings can afford to let the trailing yield catch up. And someone holding capital beyond what retirement drawdown actually needs may reasonably hold that surplus to a different standard entirely. Neither is a recommendation, both just describe how this framework itself is calibrated. Depending on when you bought, DBS presents 2 very different realities. A legacy holder who bought at a lower cost basis is likely already enjoying a yield on cost well clear of our 4.7% hurdle, making the recent dividend raise pure upside. But a fresh capital buyer entering at today's price receives a 4.23% total yield, making this Zone 4 Plus verdict critical for immediate capital deployment decisions. Singapore Exchange presents a completely different scenario. Its ordinary yield fails not just the 4.7% hurdle, but falls below our 3.2% forensic floor, marking a structural breach, because this is a structural floor breach in Zone 5 red zone. Response block framing is suppressed. With SGX trading at record valuation levels, a fresh yield calculation today shows the gap to our floor widening rather than closing. Keppel's trailing ordinary yield sits at 2.96%, breaching our 3.2% floor. Even if you add the cash special and REIT in-space distribution to reach a total yield of 4.09%, it still misses the hurdle. Furthermore, Keppel exhibits a severe leverage divergence. Consolidated net debt to EBITDA sits at 6.7 times, well above our 5 times yellow flag threshold, while its core new Keppel basis reads at a clean 1.4 times. This leverage divergence creates 2 distinct potential outcomes. If the core basis governs, Keppel is a clean Zone 5 yield breach. If consolidated net debt governs, it becomes a compound Zone 5 with both yield and debt flags. Additionally, we treat one-off special dividends and in-space distributions as asset recycling events rather than an ongoing distribution program, meaning they do not resolve the underlying structural floor breach. The 4th name in JPMorgan's conviction list, UOL Group, has not yet been run through our full forensic screen. Under our rules, no zone verdict can ever be published without a complete audit of yield, gearing, and interest coverage ratios. This is an honest gap in our ledger, not a quiet pass. And UOL is now a candidate for a dedicated forensic review given its prominent place in the bull case. 2 of JPMorgan's 4 conviction picks are already sitting below our forensic floor today. Not because the businesses are broken, but because the price has simply outrun what's actually being paid back to shareholders. That gap doesn't show up in an index target. It only shows up when you run the individual balance sheet. Get everything, 0-day access on both platforms, our full Red Zone watch list, and institutional-grade cheat sheets. Join Iggy's elite investors for 12 Singapore dollars a month. Looking at the consolidated ledger across all 4 names, DBS offers a 4.23% total yield and fails the hurdle by 47 basis points in Zone 4+. SGX sits in Zone 5 Red Zone on a structural floor breach. Keppel sits in Zone 5 Red Zone on a structural ordinary yield breach. UL Group remains unscreened. JPMorgan got the macro picture right. AI semiconductor demand is real, the Singapore dollar is stable, and local market valuations have narrowed against global peers. But a rising macro tide that lifts index targets does not automatically lift an individual stock's yield above our fixed forensic floor. Macro conviction can never substitute for a stock-level balance sheet pass. Block 16 of 23 complete. Half of JPMorgan's conviction picks fail our 3.2% forensic floor today. A structural floor breach is fundamentally different from a stock being merely attractively valued but yield light. It means the current market price fails to compensate an investor for taking equity risk. Excellent business quality does not automatically guarantee yield safety if the stock price has outrun the cash distributions coming back. Strong GDP growth across manufacturing, trade, and financial services is broad and genuine. However, evaluating income safety is a completely separate discipline. Our floor and hurdle standards are benchmarked directly against CPF Special Account, the toughest risk-free standard in Singapore. Lowering our analytical standards just because a macro narrative sounds compelling would destroy the entire discipline of forensic investing. A stock can exist inside a flourishing macro environment and still fail a basic income safety audit. Our 3.2% forensic floor is anchored to the best guaranteed Singapore dollar alternative, not to market momentum or GDP expansion. Similarly, our 4.7% hurdle remains strictly benchmarked against CPF Special Account, full stop. A headline 22% upside forecast is built on a real Singapore growth story, but it relies on 4 specific stocks. 2 of those stocks fail our income floor and 1 remains unscreened. This gap is not a reason to ignore the bull case entirely, but it is the exact reason you must know precisely what balance sheet risks you are buying into. Summing up the entire 7,000 index call at a glance, we see a clear division between macro validity and individual stock compliance. While the broader Singapore economic momentum supports higher index targets, individual asset selection requires passing strict yield and leverage gates. Let's examine the final takeaway across all 4 components. To summarize, JPMorgan's macro growth thesis for Singapore is solid, but SGX and Keppel sit in Zone 5 Red Zone due to structural yield floor breaches. DBS remains a timing call in Zone 4+, while UOL Group is an unscreened gap. A house-level index call and a stock-level forensic pass are 2 entirely different tests, so ensure you know which one you have answered before deploying capital. Block 22 of 23 complete. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.
Unlocking the future of finance. Subscribe for more.